part of the business is doing particularly well. What have you gotten right there?
So I think the pivot to health and protection, the demand in Asia for core medical care, the out-of-pocket expense, I'm sure you've seen many times in the show, is something like 40 cents out of every dollar versus say 9 cents here in the UK, or 11 or 12 in the US. So there's huge demand there. So 70% of our new business profits, which were up nicely, are derived from that focus. So that's been tremendous. And over 90% of that is regular premium, meaning those clients stay with us year after year, and 95% of the existing clients renewed this first half. So very, very healthy, client relationships on 15 million clients across a dozen markets, leadership positions. The wealth business is doing well. It's all doing what we'd hope it to do right now.
There's a lot of M&A speculation in insurance at the moment.
There is.
Would you be a seller if somebody tried to buy your Asian insurance business?
No. I think the structural demand, there's a lot of noise in Asia, right now, and certainly this first half of the year, politically and currency-wise and things, and none of it diminishes the structural demand in Asia. This is a highly underpenetrated, fast-growing market. 1 million Asians a month enter the workforce. So our sweet spot is clients who are entering the sort of the middle class, and so the structural opportunities in Asia are ahead of us, I think. And in the asset management space, less than 12% of Asian households own mutual fund type products, and we have one of the leading platforms with eSpring there. Its operating income is up 13% first half of the year. Again, good progress. So no, we're investors. We're very bullish on Asia.
So would you actually want to expand in China, and would that be through your joint venture? So
we are expanding in China. The JV with CITIC is working very well. I was just there again last week, it's China is changed last year. Its regulatory regime. They want the insurers away from the bank space. They want health and protection sold. That is what we've been doing. So we now have about licenses for about 70% of China's population. We just handed to Hunan. We got to build into this this footprint. Market share, we're still small, but it's a very high tech, very mobile based. 90% of our transactions are on WeChat in China, including the payment and recovery. It's just fantastic. I know you travel there. It's an economy that's created an entirely new era of currency. And the acceptance rate is fantastic, and we're a part of that. It's very good for our business.
So at the moment you own 50% of that JV with CITIC. Would you increase it?
Well, the law would allow us to go to 51 now. Yeah. The challenge we have with that, if Chairman Chang was sitting on the other side of you, is it's a very good business. It's growing rapidly, and we both like it. So they're a very good partner. I don't think I would want to navigate China with 100% ownership. It is having someone with their expertise, their breadth of relationships, their scope is in scale and in brand, candidly, is hugely helpful, particularly entering new markets. And they've been a really good partner, and that relationship, as you see, is growing. That business is growing very, very well. So we're happy with it.
Mike, look, overall your earnings were good. No real surprises. One of the things that we were trying to figure out is who would then regulate your Asia business after the demerger, whether it's Singapore or Hong Kong. It's gone to Singapore.
No.
It's gone to Hong Kong.
Gone to Hong Kong.
Hong Kong, absolutely. It's gone to Hong Kong. Why over Singapore was Hong Kong chosen?
So the way the process works, so the PRA, the Bank of England, will regulate the entire entity until the demerger. Right. At which point they'll regulate M&G Prudential here in the UK, and the regulatory college, the remaining regulators, then select who the next regulator is, and they have selected Hong Kong. Right. So that's a process where we have input, but we don't actually have a vote in. They're all collectively, including Singapore, feeding their concerns and their desires into the structure for Hong Kong and how they'll regulate us. The key to think of it when a global business like ours is every local regulatory regime matters, and those are stacked up on top of each other. So you basically hold AA capital in every jurisdiction, and the group supervisor, which Hong Kong Insurance IA will be, that becomes the overall supervisor for resolution, recovery, and those sorts of stresses. So
when you get under or out from under Solvency II, what do you do with the extra capital?
You keep it in the businesses. I mean, Solvency II has never been a binding constraint for us. I think it's been, as I've said before, it's a good fit for our UK business, not a particularly good fit for our US or Asian businesses. And the local regulatory regimes matter more, and we want to keep well-capitalized, strong businesses around the group. As you see, we're investing heavily in new sales, and we're investing heavily in technology and new capabilities. You saw us buy 65% of an asset manager in Thailand in the last 6 months. You saw us announce a joint venture with Babylon Health to take their technology across Asia, ex-China. Tencent has that. So there's a lot of new things we're doing. That's where the capital is going. Then, of course, you saw that 8% increase in our dividend.
Yeah.
So our shareholders are getting some of it, and we think it's allocated correctly.
Okay, yeah, I'm sure that's part of the reason why the share price is up. But talk to me a little bit about net inflows. So M&G saw net inflows a little bit weaker than I guess in some other parts of the business. So is it tough? You're doing better than your competitors. What are you getting right? But is it tough being an asset manager in Europe? So
M&G, 3.4 billion of net inflows. The Proof Fund, the With Profits Fund, 4.4 billion, which effectively is managed by, just disproportionately managed by M&G. It's their performance that consumers are buying and the stability of the 9.6 billion of capital in it. I think it's the funds and the track record of M&G. And this was, M&G is in the balanced risk categories in fund management: total return, well allocated funds, high dividend stock, total return bond funds. They lead, and they have very good track records in those. So they're not a risk off trade, but they're the more conservative places for capital. And consumers in Europe, just like the U.S., are more responsible for their retirement, and they aren't looking to be, exposed to a levered Argentinian, futures fund. What they want is a balanced return that's reasonable for the duration they need to protect their retirement. And M&G's portfolio and the smoothing of the profits fund are unique, I think, for both.
But overall, is it tough managing money in this kind of environment? We're expecting normalization for central banks. It's not coming. We have trade wars. I mean, it's quite a tough environment compared to what it was 6 years ago.
It is. I don't think there's ever an easy period to manage money. If it's easy, then consumers think they don't need you. If it's difficult, it is very difficult, and people don't see how much work's done. I think particularly on the debt side. I mean, they do all the research and equity, fund manager does, and then they do all the failure sort of measurements, and they don't get credit for anything unless something goes wrong. But I think the teams are clearly working hard right now, and the allocation of the funds is a key element of it. Certainly credit, maintaining duration on credit, maintaining the quality of exposure you're willing to take at this point in the cycle. But you see the track record of the performance of the funds. It's excellent, and that drives flows. And I think the strength of the two brands we have in the UK, people want trusted brands, and I think that matters after 170 plus years to people, and I think that drives flows. Candidly, is they know they're going to be around.
And Mike, will the cost of demerging M&G Prudential actually, when will it be offset by savings?
It's almost, I'd say, we haven't disclosed it completely, but keep in mind we're not raising equity.
So you're not raising capital.
No, you have two projects going on. You have the merger and transformation of M&G Prudential, which is an upgrading of their technology, and that gets some cost savings and some new capabilities. So you see that, and that was we held out 145 million pounds of savings by 2022. We're on track for that. You have the technology improvements with BlackRock's Aladdin platform and new trading for the asset managers. You have the TCS relationship in now for service and technology. You're seeing integration of the management teams. You're seeing faster product to market. A lot of things, distribution alignment, all sorts of things like that. So that gets you some of those savings, some of it earlier. But it's about building what we think will be a national champion. And that has to be a cost-efficient, competitive priced, operation platform, and everything would suggest it's on track to do that.
Okay, so you don't want to give a time because otherwise it's too much pressure?
No, it's just some of the stuff comes in at various stages, and believe me, there's 200 work streams, and they're all basically on track, and there's no lack of pressure on the teams that's doing it. There's a couple hundred people focused on that, and the other 24,000 roughly is business as usual. You see that in the strength of the results and the breadth of the results. But it is, I think it gives us a little room, with vendors and things to negotiate timing and costs and things. And it's going well though. There's no barriers. The key elements are the Part 7 transfer and the 12 billion of liabilities we're transferring to Rothsay. Again, that's not in. Remember, that was part of that's affected in the earnings. So those earnings numbers out of the UK are X 3 months of that. The asset management operating earnings up 10%. Operating earnings per share up 17, as we discussed before we came online. So they're doing everything they should do to have a very strong standalone company, good ratings, restructure debt, get the regulatory piece done, and this will be ready to go.
My final question, because the earnings are good, but something that's not out of, that's out of your control is world growth. Do you worry about world growth, given everything that we hear on a daily basis on geopolitics, but also central bank policy?
No. I mean, certainly the political climate affects how long it takes a client to make a decision. But if you think of the markets we're in, we have the wealthiest market with the United States and largest for insurance and wealth management. We have a leadership position there. We have the fastest growing wealth and insurance market in Asia and leadership positions. 9 of 12 markets were number 1, 2, or 3. Okay, so us and AIA are the only 2 players in that phase of scale. And then the most underserved market, Africa, we hardly ever talk about, but we're up to 5 countries there. And so we are developing capability there that's unique. And so I think we've got the right footprint to manage it as a portfolio. I don't think we'll get even growth across markets. We never seem to. There's always some issue somewhere. And the key is to allocate capital to products, channels, countries that gets the highest return, risk adjusted for the shareholders. And I think we had another good 6 months of doing that.